you want to properly value gold relative to money or value that relative to the debt that's been created, compared to 1971, it's pretty simple. And gold would be $15,000 to as high as $90,000 an ounce. I'm not saying that's where it's going, but it shows you how potentially undervalued gold is at $2,000 an ounce. Holy mackerel.
Are you feeling scared and confused, a little cautious about what's going on in the world? Today's guest is Greg Weldon from Weldon Financial. We're going to try to shine some light onto what's going on in the world, make a little sense about what we're feeling right now. Greg started his career as a gold trader at the COMEX in the World Trade Center. He then went on to work for some of the world's largest financial services companies. After that, he became a proprietary money manager for two of the most successful hedge funds in history, More Capital and Commodities Corporation. For about the last 20 years, he's been working for himself with his own company, Weldon Financial. He produces independent research and financial advisory services. Clients that he's worked with, top hedge funds in the world, money center banks, government agencies, sovereign wealth funds, central banks, global wealth managers, financial advisors, family offices, and individual investors, what I would qualify as sophisticated high-end investors. After all that, I'd like to welcome Greg to Ron's Basement.
Thanks, Ron. I would add that I take the garbage out at night too. I'm also the cleaning crew as well, so we do it all here.
Well,
it's just me. It's just me and Caitlin Ellis, my very capable COO, and between the two of us, yeah, we really rock it out. So thank you.
Yeah, well, I wanted to convey, you and I speaking, but we've got this third person who's joining us, right? Our viewer. That's who we're really making this for. And I wanted to convey to them the fact that you've worked at the highest levels of finance, and you've worked with some very sophisticated investors. You still do right now. And as we look at what's going on in the world, I guess my first question for you, Greg, is it feels like to me sometimes like a lot of America, like we're living in a fantasy world, right? Like everything's okay, everything's all right. But are we more at risk than most people realize right now?
I'd say 100%. I think that most people feel these things, and I think that most people don't fully understand what's happening, but they know something's happening. And, I'm in Palm Beach, Florida, and certainly a lot of people that are much wealthier than I am or ever will be live in Palm Beach, Florida. And, I talk to a lot of these people, and I go to a lot of similar events and whatnot. And, they ask me a lot, I'm a gold guy, had been a gold guy. I kind of get labeled as a gold guy, even though we do everything globally. What do you think? Should I be moving money into gold? And they feel fear. They can't pinpoint why they feel fear. But when you kind of question them and you whittle it down, there seems to be a common theme, which is really skepticism that central banks can keep this thing floating, that they can keep this bubble inflated, that you have to pump ever more money every time you do it. I have seen every trend throughout this 40-year credit bubble that really goes back to 71. We could even say since Volcker defeated inflation, into 1981, that was when this new cycle began of all this credit. What was different then, well, for Ronald Reagan coming off of Paul Volcker destroying the economy, like Jerome Powell is kind of proposing to do here as well, was that we had no budget deficit. We had ample fiscal latitude to spend, outspend the Russians and the Cold War and the whole 9 yards around Reaganomics. You don't have that now. You are saddled with so much debt that every time you have to print more money, it becomes exponentially more that you have to print to get the same impact. It's like there's a variety of analogies that I like to make when I do public appearances, one of which is a steroids person, like someone that's using steroids and uses it. How much bigger can the guy get? And he's getting all pumped up and he looks healthy, pump you up, right? But his internal organs are failing and he's not really healthy at all. And at some point, steroid, abuse and overuse, will kill you. So that's kind of a similar vein. You keep pumping this thing with monetary steroids. At some point, the patient's not going to be healthy. And I think we've reached that point where it's a critical mass with the debt, record debt globally, $307 trillion. That's a figure that is almost impossible to really comprehend. It's so large. especially when you compare it to central bank balance sheets, which are nowhere even close to that, 1/10 of that, maybe when you combine them all. So I think that people have this sense of uncertainty around, can we keep this thing going? We see inflation destroys the wage growth. We see that savings has been depleted. We had this huge treasure trove that the government gave us that's gone pretty much, and in this case, credit card debt keeps going up, even though you've seen a rollover in bank lending and all other kinds except for credit cards. So is this sustainable? And I think a lot of people are wondering whether it is or not. And if it's not, then what do we do to keep pace? And I think that's the question that we try and ask ourselves and try and answer to whatever degree we can every single day.
Yeah, and it feels like, I'm 53 years old, and during my adult lifetime, pretty much exclusively now, that every time a crisis came up, that there was this rush to fix things by injecting liquidity, by printing money. And I was listening to a talk that you gave a few years back, and another analogy you used was a bonfire, which I thought was great because they just kept throwing more and more wood on this bonfire. Oh, can you elaborate on that one quickly for us?
Yeah, sure. It's funny because I took various pictures of bonfires. This is a speech I did probably in Vancouver in 2020,
Yes.
where we started as the little beach fire, and it's 1987 when actually there was a bailout of $100 billion, and everyone went crazy. This is going to cause inflation. $100 billion is astronomical. And you look now, and 87 is a blip on the chart of the stock market. You can't even see it, right? So, I mean, I've lived through every one of these. When Greenspan in 1990 cut the Fed funds rate to 3%, and it drove people insane. Why? Because inflation was 3%. It was the first ZERP on a real inflation-adjusted basis the Fed had ever executed, all right? And so you can see the progression of this in way of like a bonfire. And so you look at GDP, and I use global GDP, and I measured tried to make it somewhat correlated to the size of the bonfire pictures that I had, right? And you go up and up and up to where you were in 2007, and it's one of the largest bonfires ever. How are you going to throw enough wood on that bonfire, not to just keep it at the level that it is? It needs to grow to service the debt. Keeping the bonfire at the same fire level is not good enough. You need to keep firing it larger. And the last slide was like coming into 2020, and it was kind of like, I thought COVID would be a big deal. This was the first week of February 2020, and I was warning people to lock down. You're going to see volatility. Market's going to get whacked. This is something to take seriously before the U.S. was even really involved in taking it seriously. And I showed a picture of the world's Guinness Book of Records, world's largest bonfire, which took place in Sweden. And it's like, what, is there enough wood to keep adding it? Now, I would quickly add that there is. And this is when I wrote my book in 2006, when I first said they're going to monetize government debt. And I was called like a nut job for saying that. And 2 years later, they were doing it. Well, it's like monetary Armageddon, where it's like you have the scene in the bunker of nuclear war, and you have to have both guys turn the keys at the same time. You got the Fed official, you got the Treasury official, and they basically print enough money to eliminate every dollar of debt ever printed by the Treasury. That would be something they could do and maybe will do. But then the question is, does it cost $100 or $1,000 for a loaf of bread when they do that?
If you're looking to buy gold, silver, or platinum, do yourself a favor and check out Pimbex, the online precious metals bullion dealer and sponsor of Ron's Basement. I was a happy customer before they offered to support the channel. You'll find they have the best prices, quality, and service. I think Pimbex is best, and you will too. And be sure to tell them that you're from Ron's Basement.
I like what you said about the bonfire, and that can you even keep it going? Like right now, I think it's safe to say it feels like we are at that world record size bonfire. Yeah. And just to keep it going, and even if you think about how bonfires work, right? Like you pile all the wood on, the Fed printed 40% of the dollars ever in creation back during the COVID crisis. Like that wood gets thrown on the fire. It takes a little while for it to catch and burn. I mean, it almost feels like we're at the stage right now where the wood has almost, it has almost burnt through, and we're going to be faced with, are we going to need to try to throw more wood on the fire? And it could lead to some scary, challenging economic situations as we head into the next year or two. Is that a safe assessment?
I think it is, and the way I would look at it, and you make a really good point, and the way I would, kind of position the picture and the way to look at it is, you basically had this inflation that came from all the money they printed, and this is why the 40-year downtrend of lower interest rates and lower inflation is over, and it is now an uptrend because you have reached that critical mass where you've printed enough money now, and it's the definition of inflation: more money chasing fewer goods. All of a sudden, you had the supply side kick in with fewer goods, and bam, here's what you got. And now it's a trend that will continue because they have to keep printing more money. Now, what's interesting about that, when you say, is the fire kind of peaked and is the flame starting to come down a little? Well, I would say this. Let's look at the Fed's policy path. All right. They started talking tough on inflation. Inflation went to 4. They did nothing. It went to 6. They did nothing. It went to 8. They did nothing. And they told us in 2018, and again, I think in 2020 it was, that this is what was going to happen. Powell said, this is the new paradigm. Okay, we got R-star. We know where we have to be. We can fight inflation the way Volcker did. That's the playbook we're going to use. We're going to let inflation get above the 8-year average. There's no tolerance band, meaning if it gets 2% above it, we'll start to do something. It was like, we're going to let it go as high as it wants, stay there for a while, and then we're going to raise rates dramatically to bring it down. They did exactly what they told us they would do. The problem is they waited too long to start hiking rates. So what happens? They didn't get to a tight monetary policy until May of last year. So this entire 14, 15, 16-month period where they're hiking rates, they are still extremely stimulative because the real Fed funds rate is so far below inflation. All right. So to get to a policy stance where you're restrictive, they want sufficiently restrictive, you need to be about 150 to 200 basis points above the rate of inflation, which is where they are now. But they only got restrictive in the last 5-6 months. It takes that long for the economy to reflect that, and you're starting to see it now. I'll tell you what, the employment number, people championed it for being strong. It was horrible when you break down the household numbers. Absolutely atrocious. It was a nightmare number. And then you get the ISM service sector. Service employment's been holding the economy up, right? The worst number, one of the biggest declines we've ever seen, and there's only 2 other times it's been this low. It was during the 2008 and during the pandemic. So you have some real fractures. So what's going to have to happen? They're going to have to print more money. So we watch the dollar for these keys because the dollar has been kind of a leader in giving us clues, particularly the dollar versus gold. And I don't mean the price of gold. I mean, the dollar divided by gold gives us some clues onto the monetary conditions specifically. And that's why the Fed just recently said, look, in their minutes, they said, well, we don't want conditions to become so easy as to spark the next inflation before we're ready, kind of thing. And that's where I think the Fed's fears are, and they probably make a mistake by staying tight for too long. But I'll make one more quick point to make this long answer a little shorter. But when you said specifically more and more money they're printing, and they do it so quickly now, man, if March of last year wasn't the prime example of that, SVB Bank goes up. What do? They print the most money in a single week in history outside of 3 weeks in the pandemic because of 2 banks. You have issues with the banks that we could discuss for hours right now, and we probably will touch on this, that suggests that, this could be another issue where I think this is why the Fed turned so quickly in December, is because there's something going on under the surface in the banking system.
Yeah, and it scares me as we head into these coming years that we're doing it with a level of debt right now that is typically associated with like a country coming out of a major war or a major recession or depression. Like things are supposedly good right now. Bidenomics is working, everybody's doing great, and I say that facetiously. And as we head into what could be some troubled waters, we're doing that. Am I correct that we're doing that in a financial condition as a country that is pretty atrocious?
Broke. Bankrupt. Essentially. And here's a stat for you. It wasn't maybe 15 years ago, 20 at the most, where you only had 3 countries in the world that had debt to GDP ratios above 100%. Libya, Greece, and Japan. That was it. All right. You have 41 countries now with that statistic. Okay. This is not just the US, this is global. Think about how inflation hurts people in Turkey, where the currency's down sixfold in the last 15 years, where the purchasing power of the currency has been destroyed. India, okay, where the rupee's making new lows pretty much every year. The price of gold in rupee is up sixfold in the last 15 years. This is a global issue. Again, next time you come around to it. But when you start to talk about, we really need to kind of address the bank dynamic, because
Yep.
to me, when you say, are the flames coming down again? Well, I think that certainly the banking system would give us signs of that. And some of the stats, I sent you some of the numbers. I mean, when you talk about the small banks under 250 billion, which to me is not necessarily small, but okay, 250 billion is where the Fed puts them. They hold 80% of commercial real estate loans in this country. All right. Right now, small banks are borrowing more than their cash. The only other time that's ever happened was 2008. Not only that, lending growth year over year is still $250 billion, while deposits have shrunk by $100 billion. Right? This is not sustainable. So what happens? The term funding facility, all right, the emergency lending facility the Fed set up in March to deal with SVB, has been tapped the last 7 weeks for over $20 billion and is at a new high of around $140 billion. There's a bank somewhere that's having some issues. And I think that when you look at how these banks, the numbers and the balance sheets don't work, and how you have too big to fail. So JP Morgan will come in and buy some of them really on the cheap. That's what they do. But when you say, okay, well, maybe and when you take the banks under 10 billion in assets, they have 35% of the commercial real estate loans in this country, 1.7 trillion mature in the next 18 months. It's a recipe for disaster. I think this is why the Fed turned in December. And I think this is why, pricing a 4% Fed funds for the end of the year is not as outrageous as it might sound, although the Fed doesn't like to see that right now either. So right now it's kind of a tug of war, and it's been a little tricky already in 2024.
Is it a condition that we could call with the banks right now kind of extend and pretend? Like, well, we're not going to recognize losses we've had on our bond portfolio. We're not going to recognize our mark to market, God forbid, our commercial real estate portfolio, and that we're in this position. And one more question for you: is that almost, because we hear this term lag effect, is that almost an example of the lag effect? The fact that, the bank's sitting on a $100 million commercial real estate loan. The collateral that backs that up is maybe now worth $65 million. But that loan doesn't come due until August of 2024. So it's not a problem. But that when it comes due, that it will have to be recognized, and it's kind of the almost an example of the lag effect that we hear about with higher interest rates.
Fortuna Silver Mines is a global intermediate gold and silver producer. Since 2005, Fortuna's best-in-class management has delivered impressive growth and profits. Fortuna's solid financial position and operational expertise allows for performance in any precious metals price cycle and provides a foundation from which to harvest great profits in more favorable metals markets. Investing in Fortuna is an investment in quality, long-term, sustainable production of in-demand precious and base metals.
Yeah, absolutely. I mean, kind of canary in the coal mine almost now at this point in time. But it's, to me, what I have found in doing this for 40 years, okay, and understanding where I started the business, everything was done on paper. Okay, communication, nowhere near what it is now. Information was much more valuable back then. All right. Now with Twitter, everyone's an expert. Everyone can get all kinds of information it's kind of, information is very available. But what I have found is really amazing, because people really kind of only look at the surface. They look at the headlines, they look at whatever, and they kind of believe whatever the shtick is based on who's giving you this news, which isn't necessarily news. People don't really dig into the data the way they used to. And thank God, because that gives me a business that I can, take advantage of that niche where I offer this information that tells you the reality, like the employment number that just came out. They're saying this is a great number. It was not a great number. I mean, you had more people dropping out of the labor force. The participation rate dropped not only for those with less than a high school diploma, but those with a college degree or higher. I mean, it's really rampant in the labor market. But what it takes, and it's like, ignore that. The headlines are fine. Everyone's willing to believe what they want to believe until the day when there's a story that sparks it, when it's like an epiphany, and all of a sudden the world wakes up to something that's been going on for 6 or 8 weeks. I am seeing that happen more and more often. And I think we know the reasons for that are the attention span, the media, the way people get their information, and all these things. But that's why we dig down as deep as we can. And I tend to see things early. I also know my faults as like a trader and investor. I tend to dig so deep into the data. I see it at the micro level and I get a little excited. It's like, okay, I see a turn coming. I see this shift. And you need recognition. You need the population of traders and participants to see it before it's going to, move the markets, because the markets reflect what the majority of people think. So it's a game of, I tend to be early. So I have to be able to take a couple small losses because I tend to be early, and people aren't going to get it until the day they get it. And then they get it in a big way. And you want to be involved in that day because it may be too late. And that's one of the things I think with gold and what's going on now monetarily, that's the risk. If you're not involved, at least you have some portion of your money in there. It may be difficult in terms of the risk reward of getting in, unless you just don't care about the risk reward.
The two big, I guess, manias that I've lived through were the tech bubble and the real estate bubble. And I was thinking about this the other day to go along with what you said. In both of those circumstances, and I worked in the tech field in the mid to late 90s through 2000, everything was great. Everything was great. Everything was great. And then suddenly it wasn't. Suddenly it was there were big, and it did happen rather quickly. And I would say the same was true with the real estate, financial crisis related bubble in 07, 08. I had an office in a high-end office complex here in St. Louis, and there were suddenly all these little mortgage brokers popping up, and I'd listen to these guys talking. I think, this is crazy. And it went on for a couple of years, and it was great. And then suddenly it wasn't, right? But you bring up a great point, I guess, from a risk management perspective. If you do dig in, if you do see something, you have to manage how you position yourself for that, because you can being real early can feel a lot like being real wrong at the same time.
Yeah, there's two different things: defining the trade and then executing the trade. Two totally different things. It really is. And then managing the risk, the stops, and the hardest decision and the hardest thing to do well consistently is getting out of profitable positions. Believe it or not, to me, I have found that to be the trickiest, most difficult thing. Where you're even someone that's been doing this for as long as I have, that I'm able to remove most of the emotion from it. Sometimes you get out too early, you second guess yourself. So these things are always something you are dealing with, and that's kind of the trader side versus the investor side, because those two are two wholly different things. And with the products we offer, advice for both types. We can't possibly know all the different, risk reward dynamics, risk tolerance, age, goals, financial situation, how much money you earn, what your savings are, for every person. So it's difficult to make specific recommendations, even though we do it, understanding that they have to manage their own risk. We can't do that for everybody.
You don't do that for everybody. I'm going to ask you, you were talking earlier about the prospect of inflation. I talk a lot about stagflation. It feels like to me we're moving into this environment where we still have like the table is set. Maybe they have inflation under control, quote unquote, a little bit now. The Fed wants to say, they're winning the war on inflation, but the table is set still for like a spike in inflation, and that we could move into an environment somewhat similar to the 70s, where we have the Fed's in a box, right? Do we fight inflation or do we fight a stagnating economy? And that it could become very fertile soil for the precious metals prices. Do you have any thoughts on that?
Yeah, I think absolutely. Stagflation is a word I've been throwing around since last year, beginning of last year. Very much so. And in fact, we did the report we did yesterday. One of the places we looked at was Switzerland, and you see that you have a huge rise in the number of unemployed in Switzerland. All right, and this is a country that has pretty low inflation, and 1.7 inflation against a 1.75 interest rate. All right, but at the same point, that's not what you would call tight, but it's also not easy. All right, and the QT in Switzerland, the central bank's winding down their assets very quickly. And what happens? You get this huge jump in unemployment. I mean, massive, 23, 24% over the last 6 months. It's been up in a row. So, yeah, I think stagflation, there's signs of it everywhere already, particularly in Europe. I really believe in Europe is the place, because that's where inflation could rise very quickly again, where you have more places where you have this kind of systemic debt issues around sovereign debt. So, to me, that's something that is already visible. We've seen some of that. I did a piece during the third quarter of 2023 just recently, and I had to look up the German word for stag parties. In other words, like a bachelor party, right? Because stagflation, I wanted to use stagflation. So I got this German word, and the whole piece was about stagflation in Germany because we saw a lot of it. So I think you're onto something there. And I think that is I don't know whether it's the worst case scenario for the Fed, because there's a lot of worst case scenarios for the Fed right now. But that would be really tricky. And I've talked about this before. At what point do you shift the narrative from fighting inflation to protecting the economy if that happens? And every single time, I've said this my entire career. I wrote it in my book in 2006, and this has proven out to be so true. It's not even funny, beyond what I would have even thought we'd see. All right, is that when staring into a debt deflation abyss, officialdom will choose to reflate no matter what the cost. And that certainly has been true in 2020. It went overboard with the pandemic in terms of support, but that's what they're going to do again. And yes, that absolutely plays into the precious metals as a store of value, as a way to protect the purchasing power of your paper, money, and wealth, because that's what it's all about. Stocks could go higher. If the dollar goes down, that's good for stocks. But, I like to say this on every program I do. I mean, it's like, but the stock market in Argentina goes up every year, makes new highs every year. Standard of living is certainly not higher in Argentina than it was 10 years ago. So that doesn't matter. What matters, because the peso devaluation and the whole 9 yards is much faster than the appreciation in stocks. We can see that here in the U.S. We can see a sideways stock market with no growth that crushes the debt. You have stagflation, and all of a sudden the Fed has to print tremendous amount of money just to keep this thing from really pancaking.
Yeah, that critical difference between nominal and real returns. If the S&P 500 doubles in a year, but the cost of bread goes up by 5 times, you're not doing well, right? A nominal basis, numbers, yeah, great, but go try to use that money. You're losing buying power. And I always get a kick. I want to get your quick thoughts. And you've already been very generous with your time this morning, but I hear people talk about how the dollar is strong, right? I heard that somewhat over the last year or so, the strong dollar. And I went back and looked at the DXY index and found that in like the early 1970s, the DXI was pretty much exactly where it is today, about 102. And I thought, how can we have this narrative that the dollar is strong when I know that $100, if I compare what I could buy with $100 in 1973 at the grocery store with what I can buy now, I can maybe buy 15%. Any thoughts on that?
You just said it. I mean, I just echo what you just said.
Yeah.
One of my we started a podcast a year and a half ago, and one of the first podcasts I got is the debasement of the purchasing power of your paper money. It's so simple and it's so obvious. And I went back to 1971 and compared what's the cost of the average car, what's the cost of an average 2,000 square foot apartment, all these different things. Remember, it used to be the suit or the Thanksgiving dinner index that would measure where inflation was. And when you say the dollar is strong, it's just nothing could be further from the truth. What it is stronger than the other paper currencies. That doesn't make it strong, all right, because it's not holding its purchasing power. Just look at anything you have to buy, like you just said. And I would make it this simple, all right, because I watch this religiously. It's something I look at every single day, like so many things. But really, this is a very important indicator. And I said this before. If you take the dollar index and divide it by the price of gold, you are getting what I call the gold adjusted value of the dollar. It's a better gauge of the purchasing power of your money in dollar terms. It's near a multi-decade low here, all right? So the dollar is not strong. The dollar is already on the verge of becoming very weak. And when that plays into the price rise in gold, that's when you see the dollar come down hard. There's levels in the dollar around 99.76, where this is huge, technically going back to the entire history of the dollar index, where you have this convergence of really long-term and medium-term stuff that says you get below 99.76-ish, depending on which you're looking at, the futures, the cash index, or whatever, that level would be a major secular breakdown. And that would be really bullish for gold and would definitely get it to propel through this resistance we see at 2100.
Yeah, in terms of like just the real value of gold. Last question, Greg, I promise. As you look at the world, right, in this, and I know we could go on for hours in this discussion, but in a nutshell, when you look at the world, this bifurcation that's going on, China, Russia, the BRICS, obviously the BRICS plus now, Are
Big
we
time.
experiencing, I mean, are we like approaching this point where, like we talked about with all the debt that we have in the country, the screwed up monetary system, fiscal system, we didn't even touch on social, political issues domestically in the United States. But then when we broaden our scope and look at what's going on in the world, are we potentially entering a decade or a phase where there could be fundamental shifts in relation to how gold is valued? Like, gold never went away, but the gold begins to regain some of its luster. I heard somebody say something, and I promise I'll shut up and wrap this up, but that over the last 50 years, the United States was the hegemony of the world, ruled the world, and that potentially we could come into a just by natural market forces, a period where gold and silver, maybe for that matter, to a certain extent as well, kind of become the hegemony power for a while, because those countries don't trust each other, they don't trust the United States. What's left is gold.
Yeah.
Any thoughts on that?
Yeah, no, I like it. I mean, I feel that the changes you're going to see over the next maybe 12 to 36 months, let alone the next 10 years, are going to be tectonic in terms of geopolitics. When you talk about this side of the world against the other side of the world, and I'm talking about China, Russia, OPEC, Shiites and Shia together, Iran and Saudi Arabia, everyone linked together, all about resources. You tie in South Africa and all of Africa, where China has all kinds of investment. The first thing they did when we pulled out of Afghanistan, not only do we show our weakness and no longer are we going to be the military police to the world, by the way. Okay, that's another big shift that we're seeing already taking place. But they started building their super highway that would, go through Pakistan, Afghanistan, Iran, Saudi Arabia, down to Africa, all about resources. It's a resource war. We're in it already. And when you look at the pricing of currencies, you look at Brazil, South Africa, Saudi Arabia has already agreed, Russia. I mean, the pivot was 2018 when Shanghai crude oil exchange opened, priced in renminbi, trading the Dubai OPEC price crude oil, grade crude oil. That was the beginning of the end. So yeah, this is huge for gold because the de-dollarization is a real thing, and it's something that when you talk about the political situation, the only thing I'll say is it's going to be chaos, absolute chaos bordering on anarchy potentially in 2024. And we have these wars on all these fronts, spending all this money that we don't have, all right, let alone the immigration problem, all the potential terrorists coming in, all the people that are paying taxes now that are being given away to all these people that aren't even citizens of the country. Oh my God, the seeds for social unrest are huge in 2024. And this is a time when China's going to make their move on Taiwan, on Korea even. You got a lot going on, the Philippines, Vietnam. There's all kinds of, this is a very intricate and involved story that has deep roots going all the way back to when Xi was 6 years old and his dad was killed and he was whisked away to become who he is now. So this is big picture stuff. De-dollarization, very bullish for gold. And when you start talking about, what is the true value of gold, we've had, I've sent you some of the charts and stuff. I mean, if you want to properly value gold relative to money or value that relative to the debt that's been created, compared to 1971, it's pretty simple. And gold would be $15,000 to as high as $90,000 an ounce. I'm not saying that's where it's going, but it shows you how potentially undervalued gold is at $2,000 an ounce. Holy mackerel. You say, oh my God, it's so high compared to where it's been. Look at everything else. It's really not that high. And frankly, it can go a lot higher. So
yeah. And yet most of our fellow Americans are asleep. I like to say I live in a upper middle class suburb here in St. Louis. We have a community swimming pool. I have wonderful neighbors. But if one of them comes up to talk to me at the pool and I'm not in the mood to talk, I can start talking about gold and silver. That will get them to go away. If that doesn't work, I can talk about the BRICS nations, and then thirdly, if I really want to get them to leave, I'll talk about the petrodollar. So,
if you wanted them to stay, all you have to do is bring up ammunition. You ask them what kind of ammunition they have, or something like that. You'll get a lot of people coming over to talk to you about that kind of stuff. So that's a sign right there. Come on, it seriously is.
Yeah, right on, right on. Hey, Greg, on behalf of all of our viewers, thank you. This has been great. You are a wealth of information and obviously have spent decades learning, studying. I know you work long, long hours, and for you to come on here and share that information with my viewers is great. I want to give you an opportunity here. If people want to learn more about you or learn more about your services, how do they go about that?
Sure, thanks. That's great. Yeah. You sales at weldononline.com, WELDON online, all one word, weldononline.com. I mean, we just did the 2024 special outlook for gold that we sent to you that you saw. Certainly happy to send that. Probably a lot of your listeners are affiliated with Mr. Grandich as well, who's just great, a legend in the business as well. And then we just did our weekly today. I just published it literally 15 minutes before we came on. So anyone who wants to get a copy of that, and potentially, we do the Gold Guru, it's called, and that's a daily product with a big weekly monetary, macro oversight. We do all the equities. We rank them based on their trends. We provide model portfolios, discretionary portfolios, the futures, the ETFs. We even do crypto, the base metals. And right now, what's really potentially hot is uranium, frankly, URA and some of the uranium stocks as well. And then we have what we call the portfolio playbook, which is U.S. equity based, S&P 500, which stocks, first which sectors, and then which stocks. Because if you do want to continue to be a stock person and you're not willing to do other things, well, you can stay in stocks and have a currency position, have a commodity position, ETFs. Or at the very least, give yourself a chance to keep pace with the debasement of the purchasing power of your money by being in the things that have the best chance to go up by the most. I mean, just buy and hold and this indexing. We already know the 60-40 is crushed last year. That's dead. I think this is where the next 12 months to 36 months shows us that buy and hold is dead. It's not going to work the way it used to. You have to be more active. You have to be more diversified. Being in growth, value, and small cap over here is not diversified. We know that. I think everyone knows that. But people seem to be kind of, hesitant and almost afraid to take action, to do things. And I think once you start to get knowledge and once you start to do it, people can do this for themselves a lot better, sometimes even than the professionals, frankly. And I think we try and provide tools that help people do that. That's kind of our goal, is to kind of level the playing field. I came from the hedge funds. My last firm was Goldman. And, one of the reasons I left was didn't like what they were doing. I mean, it's like you get customers and you basically take advantage of them. You take the other side of the trades. My purpose here is to try and help people with my knowledge and to give back in that way and help people, better weather what's coming next. And what's coming next, I'm not a doom and gloomer. I'm a positive person on life and spiritually and everything. What's coming next economically and politically in this country, not going to be pretty.
Yeah, I heard you say, you're not a doom and gloomer, and I've sensed that even with our conversations offline. You're a good person and a positive person, but you get paid to assess risk, exactly. And I love that. Right. And to advise people based, share what you see and assess that risk and make recommendations in terms of what people can do to protect themselves, which is a positive, helpful thing. So thank you, Greg. This has been great. Again, on behalf of the viewer, myself, we can't say thank you enough. And we're going to hope that we can get you back here sometime in the coming months, back into Ron's basement.
Yeah, it's Ronald. It's my pleasure, man. I really love participating. You do a great job. I've seen some of your stuff, so kudos to you as well. Thank you.
Yeah, and thank you to Peter Grandich for connecting us.
Yep.